Hi everyone, this is Madan Ravindran. So in this video, I'm going to explain what all factors will determine the price of the option and what is option Greeks and why is it very important for all of us to understand before we begin on option trading. In this video, I'm going to share my experience as well, like when and exactly I realized the importance of option Greeks and the time value which determines the options prices. So if I were a beginner, again, I would try to understand the option Greeks before I start to trade. So why am I saying this? Because when I trade in the futures, it's okay. You don't need to understand the price movements but much because the price movement is purely based on the price movement of the stock. If the underlying moves, the future price also will move. There might be a slight difference between the option spot prices and the future prices, but that difference is very minimal. You don't need to understand much about that. But in case of options, if you don't know which strike price to pick or which expiry date to pick, it will be a huge loss if things don't go in your favor. So let's assume, like, let's see with an example. Let's say you are buying a TCS future stock at 4,500 rupees per stock. So after a few days, if the price drops to 4,300, you can easily realize that the stock has decreased by 200 rupees, which is why you made a loss of 200 rupees in the futures. So here it is very clear that you made a loss because the stock price has gone down. So now let's consider the options. See, suppose you bought a TCS call option 4500 strike price at a 100 rupees premium on December 1st, 2024. See, let's assume that the expiry of this option is 26th of December. So let's assume that the stock price doesn't move much by the end of the expiry, but it just increased by 70 rupees. So even though you bought the option when the stock price was lower, and even now our underlying of the TCS has moved, but still the call option premium has decreased by 30 rupees here. Why is it happen? So it's because of the time value. So this is exactly what the option Greeks will help us explain, and I'll break down on how each option Greeks affects the price. So factors that determines the option price. So first factor is underlying asset price, which is nothing but the stock price. So when the underlying asset, whether it is an index or the option, if the underlying asset moves, the option premium also will move. So if, say for example, you bought a TCS call option. So if the TCS moves, then the premium of this call option also will increase. So it is directly proportional. So next one is strike price. So options becomes more valuable if the strike price is favorable compared to the underlying asset's current price. See, for calls, usually the lower strike prices are generally more valuable, and for puts, higher strike prices are more valuable. So for expiration. So this is nothing but a time decay. So this is basically the time which is remaining until the option expires. This also plays a key role in determines the option price. So the more time we have, so the more time an option has until expiration, the higher will be the price, due to the probability will be more of the option which will be ending in the money. So this is also known as a time value. As expiration approaches, the time value will decrease. So this leads to the uh, reducing the price of option, so which is nothing but the time decay. So this is exactly where the option sellers will get more advantage. So the next one is volatility. So volatility is a measure of how much the price of the underlying asset is expected to fluctuate. So we have called implied volatility, so which reflects the market's expectations of future volatility and is a very much important factor in determining the price of an option. So higher the volatility, which will be the higher the option price, because the probability of option ending in profitable will be increased, right? So because of that, the volatility will be more. So supply and demand. So just like any other business or any other financial instrument, the supply and demand plays a very important role, because if there is a more demand for any specific option, obviously the price of the option will be more. So likewise, if there is very less interest of any of the option strike price, the price will be less, right? So the price will decrease based on this supply and demand. So these factors, along with the Greeks like delta, gamma, theta, vega and rho, combined will helps us to determine the value of an option at a given time. So let's try to understand what each Greek is all about. First one is delta. So delta is a measure that shows how much the price of an option will change when the price of an underlying asset will change. See, for example, so delta helps us to understand the price sensitivity. Imagine you are looking at a Nifty 50 index option. it can be either a call or a put with a strike price of 19,000. So and the current nifty spot price is 19,050. So let's assume this is a call option. Let's assume the delta of this call option is 0.5. So this means that for every 1 point change in the nifty index, the option price will be expected to move by 0.5 rupees, which means 50 paise. So example, like so in case if nifty price increases, suppose nifty price rise by 100 points, so from 19,050 to 19,150. So since the delta of the call option is 0.50, the price of the call option will also increase by 0.50 for each point change in the nifty index. So therefore the option price will increase by 50 rupees in this case, because 0.50 into 100 points, which will be 50 rupees. So if the call option was trading at rupees 100 before the increase in nifty, so after the 100-point rise, new option price would be 150 rupees. So as per the second example, let's say if what if the nifty price decreases? Now suppose nifty falls by 50 points from 19,050 to 19,000. So with delta of 0.50, the price of the call option will decrease by 0.50 for every point drop in the nifty index. So therefore the option price will decrease by 25 rupees in this case. So if the call option was trading at 100 rupees before the decrease in nifty, so after the 50-point fall, the new option price would be 75 rupees. So positive data for call option. So as the nifty spot prices rises, the call option price increases, which is a direct relationship. See, delta will gives the traders an estimate of how much the option price will change the movements in the underlying index. So if nifty rises and you are holding a call option, your position becomes more valuable as the option prices increases. So likewise, if nifty falls, the option prices drops, right, and your position will lose a value. So in this example, delta 0.5 shows how closely the call option prices moves with the changes in the nifty index. So if the option was deep in the money, the delta would be closer to 1, meaning the option price would have almost 1 to 1 with the nifty spot price. So what is gamma? So gamma is a measure that shows how much delta will change when the price of the underlying asset changes by 1 point. So gamma tells us exactly how quickly the delta can change when the underlying asset moves. If delta is like a speed of a car, gamma is like acceleration. So it tells us how fast the speed, which is a delta, will be changing. So for example, so imagine you are trading a nifty call option. So delta tells you that for every 1 point increase in nifty, the option price will increase by 5 points. So if the gamma is 0.1, then for every 1 point increase in nifty, the delta will increase by 0.1 points. So if nifty goes up by 1 point, the option price will go up by 5 points as per the delta. So that because the delta itself will also increase by 0.1, right? So meaning for the next point increase in nifty, the price of the option will increase by more than 5 points. So gamma, so because of these things, gamma effect is especially very important during the expiry trading, because on the expiry week, even a small changes in the underlying index will lead to a significant changes in the option prices, particularly at the money options. So the effect is more during the periods of highly volatile as well, because when delta changes very quickly in response to the price movements, we have to be very careful of the gamma risk. Especially as I said, when we are holding at the money options when it's closer to expiry, because of the price of options can change quickly with the underlying assets movement. So gamma also increases the sensitivity of the option prices to underlying asset movements, especially during high volatility and also when nearing to the expiry, which leads to the higher margin requirements and the margin calls as well. Particularly this impact will be more for the option sellers. So what is theta? So theta measures how much the price of an option will decrease as the time passes. So specifically as 1 day of time value is lost. So it shows that the time decay of the option prices. So in simple terms, theta tells us how much an option's value will decrease each day when it when it approaches towards the expiration. So say for example, if delta, I said it's a kind of a speed. Let's assume delta is the speed. Theta, as I said, it's kind of a acceleration. Sorry, the gamma is like kind of acceleration. Theta is like a fuel consumption. So it tells us like how much the option loses value as time goes on. So imagine you are trading a nifty call option. The option has a theta of minus 0.2. So which means for each day that passes, the options price will decrease by 0 0.2 points, assuming all other factors remains the same. So if today the Nifty call option is priced at 10 points, after one day the option price will become 9.8. So this is purely because of the time decay. So in time decay, so the theta in real time example, how it works. So theta will be highest for options that are near at the money, and it decreases as the option moves in and out of the money. So option value loses the most when we are closer to expiry, especially the at the money options. So the impact on options buyers and sellers, say for example for option buyers, theta will work against them, because as the time passes, the closer you get to the expiry, the more quickly it will lose a value. So because of that, it's really hard for the option buyers to make a profit during the expiry time. So for option sellers, theta works in their favor, because so the option sellers will make money with the time value, right? So as option lose value over time, sellers can profit from the time decay. So especially if the option expires worthless, they can make a lot of money. So their profit is just limited to the premium that they have collected. That premium will lose its value because of the time decay, right? So the next Greek is Vega. So Vega measures how much the price of an option will change when the volatility of the underlying asset changes by 1%. So basically tells us how sensitive the price of the option will be during the volatility. So say for example you are trading a Nifty call option. The option has a Vega of 0.15, which means that for every 1% increase in IV, the option price will increase by 0.15 points. So if the implied volatility increases from 15% to 16%, the option price will increase by 0.15 points. So the number that I came up with, considering all the factors, remains same. So only I am considering about the Vega in this case. So the impact that it has, the Vega, it has a impact on the option prices. So it impact of volatility. Vega is very important for options that are very near to the money, like at the money. So as they are kind of very sensitive because of the changes because of the volatility. So it's always better, the farther the an option is from the money, so the less impact the Vega will have. So also for the IV, so Vega usually works very well with the implied volatility, because if the because like that is a market's expectations of how volatile the underlying asset will be in the future. So when IV rises, the price of the options generally increases, and when it falls, the price of the options typically decreases. And how Vega impacts the time and expiry. So Vega tends to be higher for options which has more time left for the expiry. So we can say like the closer an option is to expiry, the less impact Vega will have. Mm, so during market volatility, so basically for Nifty options or Bank Nifty options, when market volatility increases because of the events like earning reports or the economic news or some geopolitical events, so usually Vega can cause significant movements in option prices. Sudden price in volatility can cause the price options to increase. So even when the underlying asset price doesn't move much, still because of the rise in volatility, it will make a option price to get increase. And what is the impact that it has for option buyers and option sellers? So usually buyers will benefit from an increase in IV, because as volatility increases, the price of the other options are also may increase, right? So because of that, even when the underlying asset is not moving much in their expected direction, still the price of the options will move, because of the reason that because of the volatility, the price option got moved, right? So because of that, the option buyers will get benefited. So whereas for option sellers, usually the sellers of an option generally get hurt because of the increase in IV, because it makes the options more expensive. So higher volatility which will increase the likelihood of significant price movements, which increase the risk for the sellers. And the last one is Rho. Out of all the option Greeks, Rho has a very less impact on option prices compared to other option Greeks, because this mainly depends on the changes in interest rates, which do not fluctuate much as the other factors like price of the underlying asset or the volatility index, right? So because there won't be much changes in the interest, there won't be big difference in the interest rates usually. So Rho is kind of a measure of how much the price of an option will change when there is 1% change in the risk-free interest rate, like a government bonds. Like Rho will impact option prices when there is a change in interest rates, the Bank of India or Central Reserve Bank changes the interest rates, right? Rho generally it impacts the options with a longer expiry days. It doesn't usually have much impact with the short term. So because the changes in the interest rate will have a bigger options on the value of where the value of the options is bigger, right? So it doesn't have much impact on the shorter term compared to the long terms. The factors I mentioned along with the option Greeks will determine the price of an option. So understanding these concepts will help us to pick the better price or the better expiration. Please subscribe to my channel for more content and strategies like this. Thanks.